For over 30 years, the U.S. went without any sort of comprehensive tax reform. Now, within the span of 4 years, America is going under its second major tax overhaul. Congress is currently in the process of debating, drafting, and approving President Biden's American Families Plan, which has been renamed the Build Back Better Act. The overall goals are to first replace President Trump's 2017 Tax Cut and Jobs Act, and second, to raise over $3.5 trillion in tax revenue to pay for Biden's aggressive social agenda. The initial draft has made it through the Means and Ways Committee of the House and is on the floor for debate. It is yet to be introduced in the Senate. Our objective of this podcast is to make our clients and friends aware of the probable changes that are set to occur because of this pending legislation. Changes that will significantly impact our lives and encourage the federal confiscation of our wealth now and when we leave it to our children and grandchildren. Since this tax reform is still in the draft and debate stage, we plan on producing these podcasts at least once a month until the final law is set on Biden's desk for signature. We believe that there is still time to take advantage of the laws that are currently in place. Furthermore, we are confident that collectively we will continue to take measures to keep our wealth in the family. This has always been our mission statement. My name is David Phillips, and I am the CEO of Estate Planning Specialist. I'm joined today by Rick Durfee, the founder and senior partner of the Durfee Law Group, Melodie Durfee, the president of Legacy Global Foundation, and Todd Phillips, the president of Estate Planning Specialists. Welcome all.
Good to be here.
Great to be here.
Let's get right to it. Rick, can you tell us what is the status of this new tax reform bill? Some say that we are in the fifth inning. What's your opinion?
Well, as you have pointed out, it's not law yet. It's working its way through the Byzantine procedural process of Congress. And so we're really guessing at this point what the final rules will be, but there's some pretty good indicators. So we don't have a final yet, but it's on its way and we can see what's coming down the corner.
Perfect. Okay, and Todd, what are the 6 areas of tax reform that Congress is focusing on?
Yeah, well, they're looking at personal income tax, capital gains tax, inherited IRA, such as qualified accounts, federal estate tax, lifetime gift tax exclusion, and step-up in basis, which is definitely highly being debated.
Okay, well, and I know that President Biden has vowed to raise income taxes, especially for those making more than $400,000. So now that the bill is out of committee, what does that look like?
Well, it looks like they're really targeting those making over $450,000, especially, and but it depends on the different tax brackets. We don't know the exact brackets they've come to yet. Either way, we're going to find whatever it is and help provide strategies on how to reduce and get into the lower brackets.
Well, what strategies do you recommend to kind of not suppress your income, because we're making the income, and but if we have the ability to work with our income, what strategies do you suggest that our listeners implement, our viewers implement to avoid those taxes and reduce your income?
Yeah, and we'll be getting into this a little more later, but one for sure is using your tax deductions, like your contributions to your 401ks or IRAs, deferred comp plans. You want to take advantage of those. Using tax deferred investments like annuities that you don't have to pay tax each year, but you can defer it. And then of course tax free is ideal if we can get the funds into Roth. Or even the family bank strategy, which you'll be, I think, going into. And then also income harvesting, using Roth conversions and other strategies. And another one that is becoming more popular as taxes look like they're more and more on the rise is using oil and gas partnerships or limited liability or general liability companies partnerships to reduce the taxes, and that can get you great discounts on your values of your IRAs. And there's some other significant income deductions that you can have from making those strategies. And the other one, I guess, is moving to different states. You could move to a state that has a lower income tax, like move to Florida. And I know Rick, I know you have some background on clients that are doing that. Can you share a little bit about that?
Yeah, we work with a lot of clients that are moving out of high tax states to lower tax states. Just today, I was speaking with someone in a very high tax state, and they were asking me, well, how do I get my business from where it is to where I want it to be? There are a lot of issues, including what's called domicile, where you intend to live. There are issues with your estate planning documents. If your trust is tied to a particular state, for example, instead of being jurisdiction independent or portable, that can be an issue. But it's very attractive to look at states that have a different or a lower tax bracket or tax structure. It's also important to remember the overall taxes, because some states may have no income tax, but they nail you on property tax. So you got to look at the whole picture, and you've got to make sure you qualify for whatever your target state is.
And I think one of the things that works, it has worked and can work, is, for example, if you're doing a big Roth conversion, you're trying to stay within that income harvest bracket of like $329,000, filing jointly to keep you below the 24% bracket. And if that's your goal, or you're going to even do more of a Roth conversion, that maybe you move to Florida. Florida doesn't have an income tax, and you actually take up residency there. And their residency is actually relatively lenient by comparison to some. So take that into consideration. I mean, I know Florida would love to have you. I know the Floridians wouldn't love to have you. They say there's enough people there, but just some strategies that you can do, and that a lot of people like to do. And we have a lot of these strategies that are in the special reports that we're going to be explaining to you how you get at the end of our program today. So the Bombshell Battle Plan and Disinherit the IRS. And then my book, The Family Bank Strategy, as Todd alluded to that earlier. So, and you can get that book on Amazon. So, okay. Well, the next area that we want to talk about, I think, is kind of addressed to Melodie. And Melodie, your specialty is charitable foundations, charitable trusts, and what's going on in reference in the tax reform as far as capital gains tax is concerned?
Yeah, well, the overall piece is they're looking at raising it, particularly again for those that have significant assets. With the increase in capital gains tax, it does make it harder to leverage gains over time. If you can push that back further and further, then you have more capital to make more capital for you. One of the other nuances there is that the CARES Act, currently in effect, implemented under President Trump's presidency, has certain giving advantages that can help offset capital gains tax, and that sunsets this year regardless of the tax reform that the Biden administration is proposing in terms of capital gains. A couple good examples on the capital gains piece, though, is it does increase it to, the proposal increases it to 39.6% for income over $1 million. It increases it to 20% for those over $496,000, and it goes to 15% for anyone over $80,000. This is a big impact on even your small investors making a little bit in the market.
And then another thing too, we got to make sure that everybody doesn't forget, is there's state capital gains to be paid as well. So if you live in like California, and I hate to keep picking on California because I'm from California, but you have another 11% on top of that, and you can add that another 3.8%. Capital gains could be well over 50%.
Yeah, well over 50%. You lose half of what you've earned through this proposed capital gains tax initiative.
So there is a strategy that you guys specialize in, that your firm specializes in, called a charitable remainder trust. I've used it many, many times for my clients through Legacy. I just want, if you could just for a minute or two, I know this is you could speak all day on this, I know, because I've heard you, but just tell us briefly how we can, and is it going to be impacted, the charitable remainder trust, by the new tax proposals? So.
Yeah, at the end of the day, there are certain taxes that are completely avoidable. Capital gains tax is one of them, even with the increased increases that are proposed. What that means, though, is it often means a choice between paying it in taxes or making a charitable donation. A charitable remainder trust is the vehicle that you're referring to here. It's an amazingly flexible vehicle. Part of the question is, would you rather get the deduction while you're alive and not pay the taxes and have the gift go to charity when you pass away? That asset can continue to grow tax-free from capital gains tax. You can have the use of that income during your lifetime. And again, you get the deduction early on. You avoid any capital gains. Investments within that vehicle on an ongoing basis won't have a capital gains tax problem. And the gift to charity actually transfers over at your death. So it defers the gift and gives you immediate benefits in a big way. One great thing about the current plan is that charitable remainder trusts are not being proposed to have those rules change. There has been some discussion of changing some of the charitable contributions, but currently all of those pieces have been left out of the current bill.
Yay, that's good news. Rick, any thoughts on this? I know you're involved in this as well in your planning strategies for your clients. Any thoughts?
Sure. Yeah, it's been my experience that if you have money and want to keep it, and if you've been successful at investing or at buying real estate or building a business, it's going to have gain in it. And the charitable remainder trust is a powerful tool. There are trade-offs, of course, and sometimes people will look at those trade-offs and it's not worth it, but which is why I always say we should run the numbers. The algebra will tell us if it's a good idea or a bad idea. So when we run the numbers and we look at what's the overall return to the family, how much does the family keep, how much goes to the tax man, how much goes to charity, when it's worth it, we should do it.
I remember when capital gains was the same as ordinary income. You and I have been in practice that long ago.
Ouch.
When that was the case. Yes, I know. And this was a very, very popular strategy because of that. You know, with capital gains at 15 or 20%, it hasn't had people haven't been as motivated. When you throw it up to the 50%, I think it's gonna be a very, very important strategy.
Right. And it's ironic that tax policy that punishes people for doing well in the marketplace is good for charity, because if you have a choice, you can either give it to the politicians and let them do what they want to with it, or you can give it to charities of your choice, and you can decide how it's invested in society to do whatever good you feel is important. Often you getting to make that choice is better than leaving it up to the politician.
Well, let's turn the page. Let's talk about qualified money. Qualified money is anything that has to do with tax deferral accumulation and tax deductible contributions, like an IRA, 401k, defined benefit plan. Those are all kind of in the same idea of qualified accounts. So what are you seeing on this arena as far as the new tax bill?
So I'm going to say this perhaps more than once. It's important to remember that the people who make the rules can change the rules, and they're in the process of changing them. IRAs and all these various retirement types of accounts and investments that you mentioned are government-sponsored plans. They have political purposes, they have legislative purposes, and as the winds of politics change direction, they can change the rules, and they are going to, and they have. So another thing I want to point out with this IRA money, people think that, oh, that's mine. I'm going to get it, and it's going to go to my children if I still have it when I die. And that's often completely illusory. a big chunk of the money you have in your retirement accounts belongs to the federal government, and they're counting on getting it, and they're counting on you taking good care of it until they're ready to come collect it from you. So it's both not all yours, it's partly theirs in the first place, and second of all, they can change the rules. Again.
Yeah, well, and I've always said an IRA is an IOU to the IRS. So I think that's true. But there's a couple of key things that the House bill has in store for us, and this was a surprise. I think this was a surprise to everybody. The first one is if your income is over $450,000. So there's that $400,000. Remember, Biden was saying 400. Well, now it's up to 450. You cannot contribute to an IRA in the future. You're done. It's kind of like it used to be when it was 100,000, and you can't do a Roth if it's over 450. If your income's over 450, and another one that is if your IRA is over $10 million. They call it the large IRA, and I love the way they said that because they said large IRA, and then they defined it to 10 million. Well, large could end up being 5 million or 3 million, It doesn't, right now it's at 10. But the interesting thing is if it's a large IRA, you cannot contribute any more into a Roth to an IRA, period. You can't, you're done. Unless your income's under 450, then you can. Oh, that makes it, they call it Freakonomics, okay? It's really weird. And then the other thing is that if it's, let's say you have a 15 million, you were fortunate enough to just really score in your investments and it's over, let's say $15 million. Half of that, over 10 million, over the large, has to be taken next year in income.
If you have that much in an IRA, putting more in is, and I'm just going to not pull any punches here, stupid. Don't put more in if you've got that much in there. And frankly, the same is true. If you've got an income in excess of $450,000 a year, there's better options for you than an IRA. The sucker punch with an IRA is the upfront tax deduction, but the hit comes later on when you're taking it out and you're paying taxes. There are better things, and we've talked about those, and you've got them in your publications. They're just better private contractual alternatives to the government-sponsored plan.
Yeah, and again, if where we're seeing kind of a lot of the problems you and I are with our clients is that these IRAs got so big and they continue to go because their investments are doing well, and they just keep getting bigger and bigger and bigger, and it just exasperates the problem. And it's going to, but my point is, if it's has grown or it's going to grow beyond a certain quote large amount, you're going to have to take it out. You're not going to be able to keep it in that IRA anymore. You got to take it out, take it income, and report it as income for that year, and that's a mess. So
and that's regardless of age.
That's regardless of age. That's correct. You don't have to be 72 to do that. So another problem, Todd, and I want to ask this of you, the Secure Act, 2020 Secure Act. What did that do to our children's inherited IRA? If we end up having any leftover and our kids get it, what ends up happening with that to our children? And that's a law that's currently in place. I don't see that changing. What's going to happen there?
Yeah, it killed the stretch. So being able to stretch it for generations, and it used to be that you could inherit it and stretch it over your distribution table, and now the longest you can go is 10 years. And it can really, I mean, if you have a family with a lot of kids, maybe not as much impact, but where we're seeing big consequences is, pretty large estates with maybe they only have one or two kids, and those children inheriting are already high income earners, and they've got to then liquidate this IRA over 10 years. I mean, it can, lead to 40, 50, 40% taxes, depending on their state, even more. So yeah, that's the bottom line, is they got rid of the stretch.
Yeah, well, and we wrote the book, you and I did, the Bombshell Battle Plan, specifically to address the Secure Act, and then also what Biden has had up his sleeve in reference to that. And he really isn't changing much of this, except for the large IRAs. So, okay, well, let's turn that page. Anybody want to add anything, Melodie, on the IRAs? Are we good there? I'd say just get the Bombshell Battle Plan and read that
Yeah.
and study it. And
Get the plan, find out the options, come talk to us. The right option for one person won't be the right option for everyone, but there are solutions out there for the problems pending.
And I know that charities do play a very big role in
Right.
IRAs, correct? I
I'm
mean,
going
as far
to
as-
say gratuitously that sometimes you can use charitable devices and irrevocable life insurance trusts that we can talk about to capture the same amount of dollars for your family and create the same amount of dollars for charity and give nothing to the tax man. So there are some really cool planning devices that are explored in that Bombshell Battle Plan and that we can work out talking together.
yeah. Okay, great. Okay, let's go into the kind of the big one. I mean, I think that's pretty big, but Rick, estate taxes. You've always had fun with that. You know, it's a moving target. It's a political moving target. What did the Build Back Better, the BBB Act, the Build Back Better Act, what did it say about federal estate taxes?
Yeah, so the rhetoric is we're going to return it to historic norms, and there's been so many different numbers historically. It's kind of interesting to identify what does that really mean. Biden was referring, frankly, to the $3.5 million exclusion that was in place prior to the Trump administration. And right now, today, it's $11.7 million. And to be clear, because not everybody understands this, this is a transfer tax. When wealth transfers from one generation to the next, that event, that transfer is taxed. And there's an exclusion from that tax. And the target in the current bill, they're saying it's $5 million, but it's $5 million indexed to inflation. So it really comes to about $6 million and some change, depending on the math and what they ultimately get to. So today, if you have a $23.5 million estate as a married couple, you can pass that much to your heirs tax-free. Now you have to die or you have to make a gift. But after this act passes, that number's basically chopped in half, a little less than half. For a married couple, it'd be 12 million and some change, and for an individual, 6 million.
Yeah, and according to the American Family Plan that Biden had, and the Green Book, and his campaign rhetoric, the whole idea was to not only decrease the federal exclusion to something, 3.5 was, like you said, it was kind of bantered around, but also to reduce the gift exclusion. So right now there's parity with the gift exclusion and the estate exclusion of 11.7. So if I have $11.7 million and I have an asset and I have assets that are that value, I could give it to Todd, gift tax-free, estate tax-free, capital gains tax-free, gets it all.
Yes.
Okay.
Yes.
While I'm alive, I don't have to die to do that. Now there's some basis that we have to be concerned about, but let's just for purposes of what we're talking about, I could do that today. Well, the thought was that, and I've read, volumes on this, that they were going to reduce that back to $1 million, where it was in 2012.
So they're deunifying the taxes. The
Right.
gift tax is just $1 million while you're alive, or the gift tax exclusion, even if it's $6 million if you die. So to get the big exclusion, you got to die, which is not a very favorable tax plan.
But interesting, I've read in the House bill, there's nothing at all about that. So what they're going to do is continue the unity between the two, the parity between the two. So we're talking, if it's at 5 or 6 million, like you say, then the lifetime gift exclusion will be at 6. Boy, that's big. That's still pretty big. 11.7 is more. I know that, but 6 is pretty good. So what can our clients do today? Because we know it's 11.7 right now today, right? What can your clients, my clients, our listeners do today to take advantage of this lifetime exclusions?
So we actually have a gush of people doing this. If you make that $11.7 million gift in time, before the end of the year for sure, then it's grandfathered in. You've made the gift, and they can't go back and say, well, that's now subject to a gift tax. So high net worth clients that have these big estates that are more than $11 million or more than $23 million, taking that gift today is really a good idea. And it's something that needs to be done lickety split, no delay before the end of the year. And the window is closing fast. So
yeah, and I've heard in one of the provisions of this, the House bill, is to eliminate grantor trusts.
Right.
So can you kind of explain that to us?
Sure. And this has a sordid legislative history. Back some decades ago, to raise the tax rate on trusts, there were some penalties built into the tax code that if certain provisions were in a trust, that trust would be taxed to the grantor. And it was considered a defect, a mistake, if you had those provisions in your trust. Well, when they started taxing trusts at a high rate, clever planners would say, well, let's intentionally include that defect so that the income earned by the trust is not taxed to the trust, it's taxed to the grantor, who is going to be at a lower tax bracket. When with large estates or even complicated estates, if we're just doing asset protection and it's even not a big estate, that tremendously simplifies the tax reporting, and it makes it so that the non-taxable estate can grow and compound without bearing the burden of the income tax, and the taxable estate bears the burden of the income tax and is reduced. So they're taking that away, which for those that have done some sophisticated planning and have an IDGIT, an intentionally defective trust that owns, for example, a limited partnership interest. It used to be that when you got the K1 out of that partnership that goes to the irrevocable trust, the irrevocable trust gets to keep that income, which is out of the taxable estate, but the grantor has to pay the taxes on that income. Now they're going to make the trust pay the tax. And the trust has a very compressed tax rate. After only about $10,000 of income, the trust is at the top marginal rate. So instead of being able to have income up to the 450 or whatever, after 10 grand of income, you're at the top rate.
So is it done? Are we done with this now? Or do we have some time? Is it a move we can still make? Can we still make gifts?
Well, we can still make gifts. What we don't know, and I've seen, frankly, conflicting reports on this. I've seen at least one report saying that trusts created prior to 2021 are grandfathered in. You get to keep your grantor effective provisions. It's only new going forward. We got to wait and see what if that survives the political negotiation that is happening as we speak.
Well, what about life insurance trusts? Because I know that you and I and Todd and Melodie, we have all recommended life insurance as a way to either replace an asset that's gifted, to pay the estate taxes, to pay the income taxes on inherited IRAs. I mean, this is a way in which you can take a penny and create dollars, future dollars, to pay the taxes, guarantee the dollars for delivery tax-free to the kids. And we've used an irrevocable life insurance trust to do that. I had one client tell me that it was over with on October 1st. Can't do that again after October 1st. So, I mean, that she was told.
Yeah, no, that's the irrevocable life insurance trust is still alive and well. Here's what we have to be aware of. If that ILIT, the irrevocable life insurance trust, has those intentionally grantor defective provisions in it, and they pass this bill and they don't grandfather, we got to go strip them out. Sure. And we got to do it, frankly, before the end of the year. So if they pass that statute before the end of the year, we got to strip that out this year so it's not in next year. If it doesn't have those grantor defective provisions, then you're good. You're golden. You don't need to worry about it. And it just means going forward, when we create irrevocable life insurance trusts, we will no longer put grantor defective provisions in it.
Perfect. Okay. And what if I know that you guys are keen on this. You've staffed up for this day. I know you have, because I've been over to your office. I know it's like coming, like ours is. What if we have a run on the bank and everybody that's listening today calls us and says, Rick, I'm messed up. I need your help. What's your capacity here to help us?
Thank you for that. That's a good question, and something I actually have spent a lot of time and resources addressing. We are busy. We're very busy because there are people that have seen this coming for a long time and are already taking action. And I'm grateful to say that the people we started with 6 months or a year ago, we're getting their work wrapped up. So we do have capacity, but it's not infinite. We will hit an edge where we say, yeah, we're done. And I've had the experience before in the past when there's been catastrophic changes in the law that I've had to, on December 18th, tell somebody, yeah, no, I can't do that for you. But it's too late. We're done. So we do have capacity, but it's not infinite. So act quickly. Don't delay. Get a move on if you're going to want to do that with us. And whether you're working with us or anyone else, anybody who does what we do is in that same boat. They have some capacity, but it's not infinite. So act quickly or you're going to be left behind. Get on the bus or it's pulling away from the station and you're going to be standing there with
Bob
your suitcase in your hand.
Keebler is the CPA that that I read a lot about. Bob Keebler, he said, get the trust. Worry about the fine details later. Get the trust set up. Get the assets transferred, or get the ILET set up. Get all that stuff set up. You can worry about the details later. Get it in place before the change.
Right. So even the trust created this year, if they grandfather that in, and you can have this grantor defective trust if it was created this year, create the thing, set it up, get it funded, and then you're grandfathered in if that provision survives in the legislation. So you're right, get it done, and then you have the tool.
So okay, one last area that Todd mentioned was the step up in basis. One of the surprises of the House bill, I don't know that's going to make it through the Senate, but one of those surprises is that they left the step up in basis alone. So in other words, the gain that our children can inherit, and even if it's at 6 million, the exclusion's at 6 million, and they can have that gain and avoid capital gains tax. Melodie, can you just address that to the audience today on what your thoughts are on that?
Yeah, well, my thoughts are make sure we use it if they're preserving that. Part of what that does, though, is it means that in any financial or legal planning, it's important to look at which assets will still qualify for the step up in basis, as opposed to other assets that might have that wouldn't have that carryover in an estate, and do planning today to utilize the assets that won't qualify for a step up to deal with the current gift tax transfers, to make sure that exclusion on gifting is utilized fully. We want to use the assets that won't have that advantage in our planning today to preserve the assets that will. And currently, they're not talking about taking away the step up in basis, but they have talked about that before. So it's something to continue to be aware of, because while it's not in the current proposed package, it's been talked about enough. It will likely be in the next tax reform bill that comes through.
Well, and it could end up being in the Senate's version too.
Right.
We haven't seen that.
Yes.
So yeah,
I wouldn't guarantee that will be there.
Yeah, it was one of
other planning just in case.
Yeah, it was one of Biden's main targets in all of his rhetoric. So I assume that is probably still.
At the end of the day, as Rick's mentioned, those who make the rules will change them in their own favor. That's what's happening here. And my personal approach is that we should hope for the best, but plan for the worst. This is one of those situations. We want to.
I like instead of hoping, I like praying. I think we need to pray. So I think we need to
invoke divine providence where possible.
Yes. Todd,
so I want to kind of
go ahead, Rick.
Comment on something. We're in a hyperinflationary environment. So bad political policies result in inflation, and then we're going to tax that inflation. So this asset, that its intrinsic value has not changed, but its price has changed because of inflation. So we're going to come grab part of that from you. So what we have seen in the past, in fact, when the estate tax exclusion was much smaller, is that because of inflation, it was hitting the middle class big time. And I think we're going to see that again. The inflationary policies combined with the tax hikes are going to cause these taxes to be hitting more and more people, even in the middle class.
Right. Todd, any thoughts on the step up, on anything that we anything you want to add to all of this?
I guess I would just say that I mean, we are in very volatile times. There's a lot of changes that we're seeing, more than I remember since I've been watching the markets. Just overall, do your planning, and everyone's got a different situation. We've got clients, with 10 million that we need to jump in now and set up the trust, and then we've got others that are just worried about inflation, and clients that have all their money in cash, and we can't sit there either. So just overall, do your planning, and everyone's different, and we'll customize each plan specifically for you.
Yeah, and I think that kind of brings us to when Rick gives his talk at Money Show or Freedom Fest or wherever we are. Rick, you always ask the audience, so what? So why don't you ask the audience that right now? And
Yeah, well, here we've spent this time together, and if as a result of this nothing changes, we wasted our time. And right now, time is crucial because there are opportunities that are going away. There are planning steps that can be taken that if they're not taken will be very expensive. So whether you're working with us or somebody like us, get on the phone, schedule an appointment, go find out what your choices are, and take action to do something. Otherwise, they're coming for your money, and they are coming.
yeah, and we have written 2 reports, Disinherit the IRS and the Bombshell Battle Plan, that are available to our viewers today, and there'll be information on how to get that on the screen here. There also is a video that I produced back in January. It was kind of my Paul Revere warning, or my Alexander Hamilton, the best shot. Give me your best shot. It was a plea to my clients and my friends to get something going. And I encourage you to watch that. Go back and watch that, because I had some solutions in there that we weren't able to talk about today. But I think the key would be to look at getting your estate analyzed right now. Get going. And that's the way to get our attention, is to go through the estate analysis process, and that'll be available to you on the screen as well. Right now, we're just waiting for the final bill to hit the House. It's been, it's out of the House in ways. It's now in the House. We're going to see an eventual vote in that. And we're waiting to see what the Senate has in store for us. Stay tuned. We are going to try to do these at least once a month between now and the time that Biden says, okay, it's done, I'm going to sign this thing, okay? And we'll try to keep you abreast of the changes. It's kind of a fluid thing. It's an ongoing thing. So final comment from Melodie. Any comment, Melodie?
Well, I would just interject there that even if you think you have the right tools with all the changes going on, it's a really good time to look at them and update them. And if you have the right tools, there's a difference between having the appropriate vehicles in place and knowing how to use them correctly. With all the things changing in the law and in the regulation, you want to make sure that you're utilizing the tax code, the legal structures as effectively as possible. So take action and make sure you're using the tools in the right way.
Todd, any comment?
No, other than good time to do the suite. You maybe mention that a little bit, and then we could start looking at some of those options and analyzing your estate.
Okay, great. Rick?
Well, I'll just paraphrase Mark Twain, who said, no one's money is safe when Congress is in session. So they're taking action as we speak. They have a target on your back. Even if you're in the middle class and you think, well, I don't have big bucks like you're talking about, they're still aiming at you. So take action now.
Well, and as I said in the very intro, we went 30 years without major reform. We'll have now with this, we'll have 2 major reforms in the last 4 years. So get ready. We'll keep you posted. Give us a call if you need our help. We'd love to help you. Take care. Have a great evening.